Hey team, welcome back to the Brent Bruce Daily, where each day we take a look at where home loan interest rates really are, what is causing them to move, and what to expect here in the future. Today is March the 14th, 2023. It is now 2:05 p.m. Central Time. I am still coming to you from Gulf Shores, Alabama, here at the beach, but I need to make sure you know what is going on with home loan interest rates every day, especially because of what's going on. You know what they always say, whenever you want to get really, really busy, go on vacation, right? Isn't that what always happens? Right when you're about ready to try to leave, things have been kind of slow, settled down. You say, hey, I'm going to take off for a few days. And then all of a sudden, you're crazy busy. Well, here we go, having a stronger or a better than we expected employment number on Friday. We got SVB over the weekend. Now we have a CPI report that came out yesterday. And CPI came out about what the markets were expecting on the headline number, actually showing inflation a little bit higher than what we wanted to see on the core number. So as we have talked about, what I want to see is month over month readings of 0.2 on the core readings for both the PPI or the CPI and the PCE, so the consumer price index and the personal consumption expenditures. We haven't been seeing that, and we didn't see that again today. We came in at 0.5% on the core reading of the consumer price index, bringing the annual number to 5.5%. So that means that 5.5% is the annual inflation rate on the core reading of the consumer price index. Now, most people are going to hear that and say, man, that still sounds really high. And it is. It's more than double of where we want to be, but it is way lower than where we were at the peak. So as we continue to show the decline of inflation, it coming back under control because of the efforts by the Federal Reserve and the federal funds rate being increased. And also, as I said, months and months ago, now going on over a year ago, inflation was going to subside anyhow because the stimulus was drying up. This money that was being flushed into the economy, poured into the economy, it was not being poured in any longer. So that would have caused inflation to come down naturally, but the Federal Reserve doesn't like the speed that it was coming down, so they use the tools that they have, and their number one tool is increasing the federal funds rate to slow the economy, and they are doing that. I think anyone that I talk to agrees that inflation seems to be settling. We're kind of seeing that everywhere. The massive increases in prices, well, they haven't come down. And that's what people are saying. Look, prices are still very high. But when you look around, are they higher than they were last month? Are they higher than they were 2 months ago? Probably not. They've pretty much stabilized and maybe in some cases are even starting to subside. Eggs, I believe, was down like 8% month over month, one of the ones that we kind of point to. So let's take a look and see where we are on our charts, how this consumer price index number is affecting our charts and also our home loan interest rates. So if we were to jump over to the article here on CNBC, you can pull up the inflation reading here. It talks about the consumer price index for the excluding the volatile food and energy prices, which is called the core CPI, rose 0.5% in February and 5.5% on a 12-month basis, a little bit hotter than what was expected. Okay, so yesterday, we know that we had a great day. We actually ended up closing the day up 60 basis points. At one point, up well over 100 basis points, but we ended up closing at 60, up 60. Now, why is that? You could probably tell me that's because the knee-jerk reaction that happens right away, the market goes crazy, and then everyone starts to take a breath, settle down, and really look further into the reports, and then they start to kind of settle down a little bit, and it did. It ended up being up 60, which is a huge day, a great day. Home loan interest rates went from 6.875% to 6.5% in 2 days. So a lot of people say, oh my gosh, we're back up to 6.875. And in my mind, I'm like, yes, and that may take a while to come down, but it could come down in 2 or 3 days. That is how volatile home loans are and home loan interest rates are. And that's why we do this show. And that's why you need to make sure that you like, subscribe, and share so that you know what's going on day by day. Because 2 days ago, somebody would have told you, 2 business days ago, somebody would have told you we're at 6.875% for a 30-year fix. And that's not true. We are not there. It is much more fluid than that. Today, or yesterday, we ended up at where I could do a 6.5% interest rate on the Brent Bruce Daily with no points. Let's take a look and see where we are now. So back to our chart here. up 30, down 30 basis points on the day, eating half of the gain that we had from yesterday. The 10-year Treasury is up 10. I think we closed down like 18. So we've basically, again, lost about half of the momentum that we had. We're at 3.64 now. Still, I'm very happy with that because we were flirting with 4% or getting over 4%, just last week, okay? So here we are on the charts now. This is where we were previous week. We had the employment numbers come out, and then all of a sudden, over the weekend, as the failure of Silicon Valley Bank, home loan interest rates, and the bond market are the ones who benefit from the sell-off in the stock market. The bond market benefits, mortgage-backed securities benefit. We shoot up above all of our ceilings of resistance and begin to start focusing on our 200-day moving average. We have come back down now as the markets have settled after the knee-jerk reaction, where we are between this floor of support, which is the 25-day moving average, and our ceiling of resistance, which is the 100-day moving average, bouncing back and forth. Now, as I've watched through the day, I have seen us go above this and then below this, and above this and below this. So we are trying to get to where we close today over the 100-day moving average to create, hopefully, a floor of support under us. And we have another report coming out tomorrow that may help us. Tomorrow is the Producer Price Index. And if you follow this show, you know that is number 4 on my list. The Federal Reserve making adjustments to the federal funds rate is number 1. The Personal Consumption Expenditures reading is number 2. The Consumer Price Index is number 3, which happened today. And number 4 is the Producer Price Index, which is the gauge of inflation based on a wholesale level. So while the PCE and the CPI are judging how much it costs for a Snickers bar, the Producer Price Index is judging how much it costs for the chocolate that makes up that Snickers bar. Okay, it goes a little bit deeper into the process. So it does matter, but it's not quite as focused on as the PCE and the CPI. Okay, but we are going up against a very high reading from the previous year, a reading of 0.9. Now, you know that we haven't even said 0.9 really for a year. 0.9 on a month-over-month reading for the Producer Price Index gives us a lot of room to have a good report come out in comparison to last year. Now, again, the Producer Price Index, they don't look at it as closely, but it does give us a reason to maybe have a good day or at least stabilize and maybe use that 100-day moving average now as our floor of support underneath us. Where are we on our home loan interest rates? We are pulling up our report here for the Brent Bruce Daily, the very well qualified 30-year fixed conventional home loan with 800 FICO scores, 25% down, the very best of the best. We are sitting at where? 6.625% with a credit of 637. Now, that is not as good as we were yesterday, but we are down 30 basis points. But I still will say, take a look right here. Now we are down 17 basis points. We're now above the 100-day moving average. So we'll see where we close for the day. But we know that there is still a lot of pent-up profit over the last few days that the banks are just not willing. The mortgage banks are just not willing to hand over to the actual consumers in the market just yet. So we still have a lot of room, I believe, to have a great improvement to home loan interest rates because of that pent-up profit that is in that mortgage-backed security market right now, from what I can see. Now you see them showing 6.625 with 0.117 in cost or in credit. But what if we were to open this up? Now, I did a little bit of research in here, and I think United Wholesale was the one that was giving us the best benefit today if you were to pay a little bit of money towards buying some points. We talked about this yesterday. Look at how it's not costing that much to buy your rate down. So for 1 point today, you're getting back to 5.99. Yesterday, we were costing, 0.6 to get to 5.99? For 1 point that, again, we would ask for the sellers to hopefully pay, we can get to 5.99 today. Much better position than where we were. You remember not long ago, I said it was 2.3 points to get to 5.99. So we have seen a tremendous improvement, and this can definitely help us to feel better and understanding that it wouldn't take that strong of a day to get us to where maybe 6.25% with no points, maybe even 6.125. So you can see how this works. You can see how we're poised for not too much of a benefit on the markets to show a substantial benefits on the actual rates that we get to offer to our buyers and consumers. All right. I hope that's making sense. Let me know your thoughts. Make sure that you like, subscribe, and share. Follow along each day. I'll talk to you tomorrow and tell you what happened with the producer price index report that we are crossing our fingers for and we feel good about. Talk to you then.